All right. Well, hello, everyone. Thanks for coming. Um, I'm Craig Turner. I'm author of Turner's Take newsletter. I'm actually working from home today, so we're going to be doing this from my home office, and we're going to be doing futures and options for Farmers 101. This is part of a new series. We're doing webinars every month, and we're just going to build from here. We'll go into more complex strategies. And more complex and interesting topics as we move along. But everyone needs a baseline. We haven't done these in a while, and this will also be part of our YouTube channel, and I'll cut clips from here too on very specific topics that I want to go over and highlight. So a lot of people signed up for this today. I know we're in the thick of harvest, and so a lot of the farmers want the recording. I will send that to you if you reach out to me. I'm happy to get that out to you. So let's move on here. And get started. So this is futures and options. I'm also not only Series 3 registered, but I also deal in the swaps and OTC markets and in the cash markets too. So there's risk in any kind of financial product, whether it be futures, options, swaps, OTC. If you have any questions about that, please let me know, and I am happy to go over it with you. All righty. And just a reminder, StoneX here, Fortune 100 company, 100 years of experience. We're all over the world. For this purpose, for Futures 101, Futures and Options 101 for farmers, we're going to be focusing on maximizing opportunity and minimizing risk. For most of the time, maximizing opportunity has a lot to do with old crop, and minimizing risk has a lot to do with new crop. And we'll go over why that is. Not always the case, but that is really what we're kind of aiming to do here. So we're first, some of you that I've been talking to have really just have no experience in futures and options, and that's just fine. We're going to take a little bit of time here, just to go over the very basics, and then I want to get into some of the futures and options strategies that can help you out now with the present time frame in mind, meaning that it's harvest. A lot of guys are making sales, and they still want exposure to old crop. So for the futures market, for those of you who haven't been in futures for, if we are going to want to buy the commodity, let's say we want to buy corn, that means we are long, which should be an easy concept. Whether you're buying stock, you're buying real estate, you are long if you're buying, and you're short if you're selling. Some people said they have, at first in this market, they think, well, how can you sell something you don't own? Well, you don't really own the corn or gold or crude oil when you buy it. You're not receiving it in the futures market. You're just speculating the price going up. There's never any of that physical commodity changing hands. Same way in the short side. We're not actually selling anyone crude or corn or soybeans or gold. We're speculating on the price going down. Now, if you're a hedger, you're not speculating on it, but you are hedging your risk. If you are selling the futures, you're going to be long the physical, and you're protecting yourself. You're basically making forward sales. So it works both ways, whether it be spec or hedge. Then there's options. All right, so there's a call option, which contains the right to buy. We don't have to buy the futures of the commodity, but it does give us the right to buy. It gives us that option to buy. So if we're bullish, we want to be long those calls. And on the same side on the put, if we want to have a put, you want to be, have the right to sell that option now or sell that commodity. If you're bullish, and let's say you're a farmer out there and you sold new crop and it's going to turn into old crop and you kind of wish you to make that sale, you can buy a call. You can buy the futures, get long. In the beginning of the season, there's a ton of money that goes into these inputs. There's a massive amount of risk that these farmers have, And in that case, you can either sell the futures to hedge your risk a little bit, make a forward sale, or you can buy an option, a put option that protects you from lower prices, right? So this is where the minimizing the risk comes in and trying to maximize our opportunity. So what exactly are we talking about here? You see a lot of definitions for options. What I just like to everyone to remember, if this is new to you, think about options as similar to insurance. There's going to be a premium, which you pay for it. There's going to be a limited risk, and just like life insurance or health insurance, whatever it may be, house and car insurance, if that policy should come in the money, there's a payout. If not, it expires, worthless. Just like any other kind of insurance you have. An option is is basically structured the same way. Let's get into that. Here we go. Technical difficulty there. All right, so our options difficult. When I'm on the phone or I'm at a show, I'm going to be at Nebraska Ag Show in December. I'm going to be at the Iowa Ag Show in January. I'll be at the Van Trump FarmCom Conference in January. I'll be at Commodity Classic at the end of February. When I go to these shows, people are interested in options markets, but they think it's difficult. They've never tried them before. They're more comfortable with futures or sales. Here's the thing with options. People get online, they see something like this, call option formula. This is something I learned in school. It is very complicated. I think it's unnecessary. And then the other side of it, you see these option definitions, and the eyes just glass over immediately, on what these means. I mean, the formula and the definition is fine, but just like my life insurance, I don't need to actually understand the actuary table, or be an insurance salesman or an underwriter to really know the nitty gritty of it. So there's really no reason to panic. If you go down on the internet and get into these option definition wormholes, you could probably making things too hard on yourself than you need to know. Let me just give you the basics here for those who are new to this. If you're a put option buyer, we're buying the put because we're concerned that prices are going down. We buy the put, it means we're long the put. It means we have the right to sell a commodity at a certain price. We have the right to exercise it into futures if we want to. But because I own the policy, I have no obligation to eventually get into a futures contract. My only risk is the premium that I pay, and my gain is unlimited, depending on how far the price goes in my favor. And that would be to the downside. To the upside, if I were buying old crop, I'd be buying a call. I'd be long the call. I'd be long, basically long prices in this insurance policy. I'd have the right to buy the underlying at some point, and I hold the right to exercise and to be in long futures if I choose to. The buyer, again, has no obligation. The loss is limited, just like my life insurance premium. I'm only paying a little bit a month, but the gain is unlimited in the futures market. In my own insurance, the gain is up to what I'm insured for. But it's the same thing. It's the same concept, at least. And, you'll see fancy formulas and how these things are priced, and you'll see some pretty long-winded definitions. And as you get more comfortable with puts and calls, I would take a look at those. But for right now, as an introduction, so everyone understands the concept of what we're doing, this is what calls and puts are. Now listen, just to go over this again, option components. If you're the buyer, you own the right to either buy or sell if it's a call or a put. Now there is someone selling you this option, and they are basically the grantor of these rights. Just like how someone writes me an insurance policy, someone writes me this option. So I could be the buyer of the option on the exchange, where I want either the right, the right to be long or short, if I'm getting the put, but the person who writes these is going to be giving up that option, that option for a premium. The underlying commodity is going to be based on a futures contract. Could be corn, could be gold, could be crude. The strike price is going to be our exercise price, meaning at what point is this option in the money, or is it trigger? Expiration date, all options have expiration dates. And the premium is what I cost. What is the value of this option? So to give it a little bit more of meaning here, if I buy the December 2023 $5 corn call, assuming, let's say I have to sell corn here, it's harvest, yields are better than expected, I didn't contract enough, I can't store enough, I got to sell some off the combine, we're at $4.90. I want to buy a $5 Dees corn call. Here we go. Someone else is going to sell me that $5 corn call, probably because that person thinks it's not going to $5, and they're going to keep that premium and put it in their pocket. I'm willing to pay for that option in case the market goes higher. That other person is basically saying, you know what, I don't think this market's going to go higher. I'm just going to sell you the right to own it, and I think I'm going to keep your premium. The underlying futures contract in this case is December 23 corn. My exercise price is that $5 corn call. So if corn is above $5, I can execute. If we're at 505 or 510 or 520, I'm still long futures from $5. The date on this particular one is November 24th, so right around Thanksgiving. But that's usually how it works. You can have different expiration dates depending on the futures, but if it's like, say something December 23rd, 2023, typically the options expire the month before, in this case November, towards like the end of the third week of the month. That's the general rule on the grain and oilseeds. And in this case, when I looked at this chart and I took this down, we were about 7 cents per bushel. Volatility is kind of low right now. So for 7 cents per bushel, I can buy a call option that's good between now and November 24. And in case corn explodes higher, I could be long corn from $5. And if we don't move at all, if we stay at 4.90, I'm out 7 cents. Go to $6, I'm up 93 cents, right? Unlikely, but just, we go to 0 and I'm only down 7 cents, right? So that's how these things work. So there are option components, very important. We have premium, and you'll hear that term a lot. So the premium for December 23, December 23 corn's trading $4.89, $5 call is 7 cents. Our premium is 7 cents. And there's intrinsic value and time value. So intrinsic value is how much it is in the money. This call option isn't in the money at all. It's actually 11 cents out of the money. So the intrinsic value is 0. But what if corn rallies and we're 5.25 and I own a $5 call? Well, then that intrinsic value would be 25 cents. So there'd be 25 cents in the money. What's the time value of this? Basically, if there's no intrinsic value at all, the time value is just what the option's worth. In this case, the time value is 7 cents. So just in terms of moneyness, it's a really nice concept to understand. If you are long puts, let's say we're a farmer and we're long for new crop 24, and we have our put strike price here, let's say it's $5 corn or, $12.50 soybeans, whatever it may be. If we're above the market, it's out of the money. If it's below the market, if soybeans came down to $10 or corn down to $4, we would be in the money on the put. And it's on the opposite. Let's say it's old crop here, and we have a $14 old crop soybean call or a $5 old crop corn call. If prices are low, we're out of the money. As prices go past that strike price, we're in the money. Now, one thing to remember as time goes on, that time value we talked about decreases. So an option that has a whole year left has more chance and more volatility to be in the money for us. But an option that only has 6 weeks or 2 months left has less time for us to be in the money. So as we get closer to expiration, that time value leads away. Same way, on life insurance. If you have a 30-year, a 20-year, a 10-year, or a 5-year policy, that monthly premium is going to be lower. The farther out you go, sorry to say, the more chance that life insurance policy might come in. Same thing with these options. The farther we go out, the odds of that option getting into the money or deeper into the money, increases, and the market's going to account for that. So finally, if we're buying an option, let's say we're long a call or long a put, so we want to get out, there's only 3 ways to do it. Either they're going to expire worthless, they're out of the money. In our corn example, if we just stay at 4.90, we lose 7 cents, they expire worthless here. We can always offset it, meaning let's say we rally and it's worth 10, 15 cents. We sell that, we can buy an option, we can sell an option. We can always offset it. Maybe the trade didn't work out, it's only worth 2 or 3 cents now. We didn't want to risk the whole 7 cents. We sell it for 2 or 3 cents and then exercise. Now only the buyer can exercise. Seller cannot. One of the things with selling options is that you don't have control over that. But the person who is long the call, who owns the call, or who has bought the put, is long the put, they have the option to exercise if it is in the money. Okay. Finally, just closing out an option premium, we're offset, and it just means we're going to sell and liquidate. If we exercise, that means we're going to be assigned the futures position, and then at expiration, if they're worthless, they'll just expire at 0 and come off your statement. So this time of year, depending on the time of year, is depending how we do these next 2 topics. I usually look at maximizing opportunity in terms of old crop, and we're getting a lot more interest in old crop now that we're in the thick of harvest. And, when we're in, the spring and summer, sometimes we'll have a lot more interest in the new crop, but especially more in the beginning of the season. But let's talk about maximizing opportunity, and this is where old crop's going to come in. So, with old crop, there's always a fear of missing out. There's always a fear of missing out on any kind of sales, whether it be, new crop sales or old crop sales. Now, when the market gets tight, old crop tends to go up much faster than new crop. Old crop is what needs to get rationed, when we have shortages, which means old crop is the one that screams higher. So when there is a fear of missing out, when I've been working with clients, and let's say we had a target at $6 corn, and we rally 30, 40 cents, and we get there, and it's like, okay, we're going to sell, and sometimes we sell, and sometimes we don't. And there is this fear of missing out of prices. So, how do we combat that? Like how do we make a sale now, and then also still take advantage of prices going forward? So this is really the crux of the presentation. This is why we're doing Futures 101 for farmers, for futures and options, all right? For this part of the presentation. That first 15 minutes was just setting, basically giving everyone a baseline so we have some kind of understanding, even if it's just an elementary basic 101 understanding of futures and options. This is this is why we're doing it. So let's say you have to sell corn, right? You didn't sell enough new crop over the spring and summer. Your yields were fantastic. You can only store so much. You don't want to do commercial storage. It costs too much. What do we do? So one thing is we actually, let's say it's corn. Crop is corn. Our futures, when I did this chart, we were about 489. And again, this, let's say we just think there's going to be a rally because of South America or demand's going to pick up. We can buy a $5 call in December for 7 cents. If we want to go out to March, it's probably closer to 12, 13, 14 cents. But just give you an idea, that's what we're looking at here. And if we were going to do something like that, what does that look like? So here's December 2023 corn. We buy this $5 call. Well, this $5 call, which is represented by that blue line, costs us 7 cents. So that yellow area is the premium we're laying out, right? We are paying that 7 cents for every 5,000 bushels. That's $350. And that is basically our cost, right? The futures are trading here. Now, something should happen. If someone comes in big for buying corn, or we get lower South American acres, maybe there's just another year of South American weather issues, we can go higher. And basically what this green area represents is, the higher you go, penny for penny by expiration, that's how much you're going to be up. If we, go up to 520, you're going to be 13 cents positive. Why not 20 cents positive? Because you paid 7 cents for the option, right? So it'd be 520. Let's say we went to 520. Yeah, the option's worth 20 cents, but you paid 7 for it. You're able to make 13 cents on that move higher. If we go up to, where's risk resistance? 570. For some reason we go to 570. That option's 70 cents in the money. You paid 7 cents for it, so you're up 63 cents. So it's a way to make that cash sale. And if there is a strong rally, you have basically, this is revenue insurance. This allows you to make this sale now, and if it keeps on going higher, or we get a big rally here, you can still participate in a big chunk of the move. It'll never be penny for penny, but you can get a significant, capture a significant portion of it. Now, let's say you do store, you sell your grain, you have some in storage, and we're going to wait. We're going to wait for South American weather. Let's say you sold half your grain in new crop, you stored the other half of it, and we're saying to ourselves, okay, I'm going to sell. I want an option going out to July. I'm going to be looking for a spring or summer rally to sell into. And here we go. Futures are 488, 49, and let's say we choose 580. 580 is a nice resistance point on the July 24. It's a nice target on the chart. I'll get to the chart in a second. And when I looked at this, the 580 calls were 15 cents, which puts our break even at about 595. The strike is 580. It costs us 15 cents to get in there. 595. Why am I showing it this way? Because let's say you sold half your corn, we're putting targets up here, or maybe it's not the elevator, maybe it's just in your head, and you're like, what, if we make this run, and I picked this area because these were the highs back from the summer. We make another run back here, you want to sell. Some people I work with, one of two things happens. If we get up here, people have trouble selling because there's a fear of missing out. And if the market is rallying hard like that, the options are going to be a lot more expensive. So sometimes what we do is I'll say, okay, we got our target's 580. Let's buy a 580 call. We'll spend the 15 cents, right, which represents that yellow line in there. And if we get up even anywhere close to this area, we can pull that trigger. All right, we are just going to ring the register and buy it because we know if the market keeps on going higher and we have a serious weather issue, maybe not just in South America, but the United States, we already bought that call. I've worked with clients in the past where we didn't do anything in the preseason. We get up to our targets, and we've all been there. Things are crazy. You don't know if it's going to ever rain again. The heating shut off, and you're living and dying by basically weather models that are coming out every 8 to 12 hours, and no one knows when to sell. Well, and no one wants to miss out. Well, it's a whole lot easier to make that sale if you bought a call for 5, 10, 15 cents at your target price for the summer, and if you get up there, you ring the register, and you still have that call in place. We call these courage calls, and basically it makes decision-making a lot easier when the markets are fast and you don't want to miss out on a potential rally. And we talk about, capital in terms of money, but there is mental capital that is happening during the spring and summer during some of these rallies, and having the mental capital to make decisions, financial decisions with the crop really helps out. I mean, the 15 cents alone on this 580 courage call could be just worth its weight in the mental capital it gives you back, during these times of volatile markets. So let's say you don't want to do options. Some people just want to do futures, and that's fine. That's happening right now. There are farmers out there, they don't want to sell. They want to store it. They don't have enough storage. They don't want to pay storage fees. So they're like, I'm just going to buy the futures. I'm going to sell it all on the cash market right now. I'm going to collect all that revenue, right, for your corn. I'll buy it back on paper. The margin on corn right now is, I want to say it's around $2,000. That's 40 cents. When you sell corn for $5, 30 to 40 cents of it needs to be used for margin, and you go ahead and buy it on paper. By the way, if corn stays at that price for the next couple of months, you get that margin money back. It's not like it's option premium, which is probably something we should, margin is just kind of like a little bit of a down payment that you have. So if, let's say, corn is trading at 488 and I buy the futures and the margin is $2,000, and I sell it tomorrow for 488, the margin's still $2,000. Like, my account's still the same. The exchange just wants to see that you have at least $2,000 in your account to hold that position. So let's say I have a $10,000 account. I buy one corn future. The margin's $2,000. All the exchange looks at is like, hey, does this guy have $2,000 to hold one corn position? Oh, he has a 10. Then we don't care, right? Go about your business. So it's not like an option premium. It's just, I almost think of it as like a down payment. Bank looks to see, hey, does this guy have 10, 15%, 20% in his house? Okay, great. And then, if I'm negative, if I'm underwater, that's when you get a margin call, right? You don't get that in the banking system, but you do get that in the futures and options system. So not exact. This is not a 100% exact correlation, but just to give you a flavor of what, what futures are like compared to options. It's a nice, I'd like to use it as a comparison. So let's say we buy futures, and I already wrote the margin down, 17.25. You do have basis risk, that your basis can change based, which would be a little bit different than what you have in your cash position. But futures markets tend to move a lot more than basis, usually, not always, but usually. So here, let's say you have corn, you sell it locally, you collect all that revenue, you buy the futures, the margin's 17.50. So what is that? 37 cents, 35 cents, something like that. And if we go down to $4, you're going to be down 88 cents. If we go up to $6, you're going to be up $1.12, and anything in between. And it's very straightforward. With the options, there was, those white areas, you didn't lose anything except for the premium that you paid for the option. That's where the limited risk comes in. But on the futures, no, you have just as much risk to the upside and downside. You're just replacing the cash for the futures position. So that's another way to do it. And the guys will do this to basically so that, storage costs are just too much. They'd rather just own it on paper. And that's a good way to do it too. So that is how we go about managing our old crop opportunity. Like when we get to the old crop situation, which you're on now, we're transitioning from new crop to old crop, there are 3 big ways to basically maximize that opportunity. And 2 of them through the options and 1 of them is through the futures. And I think when it comes to the options, I like the courage calls. If we want to store grain and bet on it going up higher in the spring or summer, I like the courage calls to sell into on those big rallies. And then if you're forced to sell, you can buy the futures. I prefer buying a little bit of an out-of-the-money call. It's a limited risk way. If you get a huge rally to the upside, you're gonna be in you'll participate in it in a big way. It might not be penny for penny, but it'll be substantial the farther you get into the money. Now, one thing, if we were doing this presentation 3-4 months from now, we may have lead it off with managing risk part of futures and options. And for futures and options 101 for farmers, managing risk is a big deal, and a lot of times it's going to be on the new crop. And unless you store 100% of your grain, which I really don't recommend, but if so we're going to talk about managing risk in new crop. If you do store 100% of what you grow, then this also applies to you for old crop. But when I do my marketing program through Turner's Take, and the clients that I work with, the consulting that I do, we tend to be at least 50% sold old crop, even if you do have a lot of storage. So new crop cost. So here's the thing with new crop. You have a very high cost, especially over the past couple of years. We've seen how inputs have risen, right? So we've got fertilizers, seed is gone up. Land is certainly expensive. Equipment, labor. There's just a lot of money being poured into these crops this year, or the past couple of years, and that certainly makes a difference. So, if there is a lot of money going into the crop, there is a lot of new crop risk. We've got very volatile markets, and we've had very volatile markets since COVID started, to the upside and to the downside. And if this is your business, you don't want to be that exposed. So you're either going to have to make cash sales, forward sales along the way, or use the futures and options market. So there's a couple of different ways to do this. If I'm a farmer, one of the ways I'm looking at is in your new crop break-even insurance. And you can use this for soybeans, you can use this for corn, you can use this for wheat. We plant more corn and in terms of bushels and tons, we produce more corn than anything. So we're going to keep on using corn as an example here. But let's just say, for whatever reason, based on land costs and labor and everything else, your break even, your production that year, your break even, based on average production, you think it's going to be $4.50 a bushel. Well, for December 24, the 470 put is 20 cents. So if you bought the 470 put for 20 cents, your break even is $4.50. And for that kind of a product, you're basically guaranteeing you're not going to have a loss. Now you may have revenue insurance, you may have some kind of insurance through the USDA, maybe that's up for 85% of production. You can use these options for the other 15% if you don't want to let it ride. But this is something that you can do. And again, the yellow part here, represents what the cost of the option is. And you can just see this green area, like no matter what happens with prices, you'll have a price of $4.50. So even if we, let's say we had 94 million acres of corn next year, which would be a repeat of year over year. I seriously doubt that'll happen. But if we have 94 million acres of corn and a 182 yield, we'll have over 3 billion bushel carryout. And yeah, we're going to find out what the new lows in corn are. I don't think it's $3. Could be 380, right? And could be 360, 3 billion bushel carryout. Who knows? Again, that's with 94 million acres and a trend line yield of 181 or 182. What's more likely to happen with corn is we have 90, 89 million acres of corn next year, and soybeans and wheat, come up. Soybeans up probably 3, 4 million, and wheat up 1 or 2. Still, though, we're going to be at over a 2 billion carryout, maybe even 2.5. Does that argue for $5 corn? It might be more like $4 corn at that point, especially if soybeans and wheat go back to abundant or burdensomely supplied markets. So this would help hedge that cost. Now, something else that I like, and we're going to get much more into this in our 201 advanced option strategies on the next webinar. But I want to introduce the idea of the new crop collar. Something a lot of guys use. I actually like to use a three-way where I sell a call spread up top to limit my upside risk, and then I just buy the single put. You pay up a little bit more for that, but it really helps with the risk side in case the markets go sky high. But for this new crop collar, what we're going to look at here is for corn. For new crop, these corn was trading about $5.15 a bushel when I looked at this. Let's say we take a look at the December 2024 corn. I'm going to be looking at the $5 put. That $5 put is 34 cents. Now listen, if I buy that $5 put for 34 cents, my break even is about that break even put. So that what is that 466, right? It's okay, and I don't know if I really want to spend 34 cents on a put for $5 corn when we're trading at $5.15. Now, what if I also sold, not bought, not buying the call, I'm writing the call, all right? And this is where we're now bleeding into 201. All right, this is as advanced as this webinar is going to get at 101. We're just going to start to introduce the concept of writing and selling calls, and we'll get much more into that in 201 next month. But let's say, going back to our previous slides, instead of buying that call, I'm writing the call. I'm actually giving someone else the right to be long corn above 550 for 30 cents. Now, if I'm going to grow the corn, then it's actually covered because I'll actually be long the physical selling that covered call. And again, we'll go more into that next month. But what I want you all to realize here is, what are we going to be doing here? We're going to be buying this $5 put, buying the $5 put for 34 cents. I could sell that 550 put call, the 550 call for 30 cents. So I'm paying 34, collecting 30. So I'm actually shelling out 4 cents to have protection under $5 instead. So I'm paying 4 cents instead of 34. The rub is, if we go above 550, I have now the obligation to sell corn at 550. Some people like riskless collars. So they'll actually work an order in the market to do this at even money. So let's say these futures went from 515 to 520. I bet this $5 put is now worth 32 cents. I bet this 550 call is now worth 32 cents. That trade gets executed at the exchange at a costless rate, where I'm now long the $5 put and short the 550 call, meaning that I can be short, I have the right to be short corn at $5, but I also am giving up I'm basically given the obligation for someone else to be long corn above 550, which means if that comes in, I'm going to be short from 550. But I like that. If you're going to be long the physical, that is a nice way to manage that risk. Now, again, think about it this way. This is what it looks like visually. You are going to grow 5,000. Let's say you're going to grow 200,000 bushels of corn. Let's say for 5% of that would be 10,000 bushels. We're going to go ahead and do this collar, right? So we're short the 550 call, and basically if the market went up to $6, it'd be, we would basically we'd be selling corn at 550, and we'd be down down 50 cents. We still have the physical corn, right? But on paper, we'd be down 50, while the physical corn would be up 50. So that's the risk side. But the benefit is if the market were to go down to $4, even though by the time we harvest grain, if we have a great crop on a lot of acres and corn's now at $4, you actually sold it at 5 on paper. So now you're up $1 or you're hedged $1. So it's what's known as a collar, and these doesn't have to be we can look at the 450, $6 one, or sometimes people will kind of double up. I prefer to actually sell the spread. So I would sell like a $5.50, $6 spread, and we'll go over that next month. Maybe I'm only collecting 20 cents, and it helps pay for the 30 cents for the $5 put. So maybe all told, my break even's $4.90, but I only have 50 cents of upside risk. So this red shuts off at $6. So if we went to 7 or 8, and I still owned that corn, I'd still participate in $6 over to $8, right? And that's something we'll get much more in depth on. But just the concept of the collar, where you're going to be long this grain because you're growing it, and you can buy a put and sell a call, is something that you'll hear a lot about. It's a very popular strategy, and we're going to be building a lot of things around it over the next couple of months and year as we go forward in these webinars. So there's also just a new crops board sale or an HTA. If anyone here has ever done an HTA, it's very similar. The only difference between the HTA and doing it on the futures board is if you do it the HTA, they charge you more money because they're the ones who are going to have the margin risk and fund the margin calls. But if you do it yourself, it's going to be a lot cheaper in the transaction cost, but you're the one that has to come up with the margin and the margin money. That is why it works. That's why HTAs cost more than a round turn on a futures market. That really is it. So let's say the futures are 515. We sell these 20 for corn. The margin's 1,000, 1,100, almost 1,200. And here it is. You can always make that sale, right? So we're trying to manage risk here. We're trying to manage the risk of what happens if markets collapse. So if we sell corn at 515 and we just keep on going down, that futures position is going to be in the money. If the market goes higher, we're going to be down in the futures account. But the cash grain is going to be going higher, and you still have control over your bushels if you use the futures market. I have people at StoneX. You can use me for an HTA. We have a group here. You can basically have an account with me. We can if corn gets up to 525, we can sell it here as an HTA for you. We'll fund the margin calls. You can still deliver it to wherever you want to, and you still have control over your basis as you do it. It's going to cost more if you do it that way. If you sell it on the futures market, transaction cost is going to be a lot less than the HTA, whether it be here or anywhere else. But if we rally, who's on hook for the margin? The futures account is the holder of the futures account. So you still can do it, and some people are very comfortable with that. Some aren't, but that's how we do it. So what I would recommend to everyone here is when farmers look at futures and options, what we're really talking about is either managing risk, because there's a lot of cost on the inputs here going into it, or we're trying to maximize opportunity, because as you're making sales responsibly, we all realize that you can always get a big rally out of nowhere. And then how do we at least find some way to participate that? Because no one's calling a bottom here and no one's calling a top. It's just not how this works. So we're always kind of trying to seesawing between fear and greed. And the fear, the real fear comes in, or the most risk you'll probably have, is when it's the beginning of new crop season and you're planting and all this cost is going in and nothing has been sold yet, right? And the greed, a lot of times, that is the old crop weather rallies in the spring and in the summer, right? And how are we going to go about managing that, those kind of expectations and those emotions when we're marketing the grain? And puts and calls can really help those decision-making processes. So here we go. That's, we're planting. That's our new crop risk there. And we've got old crop as we're harvesting and selling. So, it's the put versus the call, and the combination of the two. Again, managing risk, we're usually using puts. It's usually centered around new crop, can be centered around old crop if you store a ton of grain. And then for maximizing that opportunity, a lot of times that's going to be, buying courage calls to sell into, or, we're selling grain because you had a great production year, and, we're going to replace some of these cash sales you make with a call option just in case we rally during South America weather rally, or, we get an early spring, U.S. rally or something like that, or major demand. So this is futures and options, 101. Going forward, we are going to get much more, we're definitely going to get deeper into the weeds here. I have a YouTube channel. Turner's Take does have a YouTube channel. We're going to start posting videos on there. You can follow me on Twitter. We're going to start, posting the videos on there too. I work with a lot of farmers. I have a team of brokers that works with farmers, and I think there's just a lot of ways to help. We're going to have volatile markets. It's just the way it is. I don't think things are going to get less crazy around the world. Probably going to get more. I'm a little bit of a cynic that way, but things don't seem to be going so great. So listen, we help farmers manage that new crop risk. We really try to help farmers also maximize those old crop opportunities. Some of you will speculate. There are definitely, I saw the attendee lists for this. There's speculators attending because they do follow our GrainRex. Listen, if I think corn's going to be bearish, we will tell that to the farmer. We tell that to the spec trader. We still tell that to the end user. It doesn't matter who you are. The opinion still stays the same. How someone goes about, that view is different, right? Whether you're a spec trader, an end user, or a farmer, but the opinion doesn't change, right? So we're here on the farming side, help farmers manage that new crop risk where you got the biggest front loaded and also the opportunity. So a couple of things here. If you do not get Turner's Take, you can take your phone, you can scan that QR code. It will take you to our website. It'll take you to the MI website. Now, what I like about market intelligence here at StoneX is you can get Turner's Take, but a lot of the things that I talk about are fundamental, and it's supply and demand. It's going to be exports. It's going to be crop conditions. It's going to be, we have ending stocks compared to prices in the past with linear regression models, spreads, histograms, historical pricing, seasonals. All these things are listed on market intelligence. So if you take a trial to Turner's Take, and if you want the weekly, you can get the weekly indefinitely. The daily one for clients you can subscribe to too, but that's for clients, and that comes out daily. But for the weekly one, where we're giving you basically our big picture ideas of the market, and it's supposed to be in junction with the podcast, you can also get this a trial to market intelligence and see all these tools. Not only are you going to get the WASDE estimates and some of these very timely reports like NOPA review and reporting on that, but our interactive reports have really come a long way. I use them all the time, and if you look at my Twitter feed, a lot of the charts that I'm pulling and the graphs and the information that I'm pulling for those charts on Twitter are coming from market intelligence that you would have access to. So if you are interested, you can bring up your camera. You can use this QR code here, a little dinosaur friend. It will bring you to the market intelligence page, which is actually already promo coded with Turner's Take. So you get Turner's Take, and you get to take a look at market intelligence, and it's very good. I highly recommend it. So I allotted ourselves here about an hour, but honestly, for Futures 101, probably only needed 45 minutes, and I think that's where we're going to end up. Going forward, eventually we are going to need the full hour. We're going to be talking about advanced option strategies. We're going to be talking about spread trading. We're going to be talking about how I look at the market. Money flow. What exactly does money flow mean? What is the money flow doing? Is it technical? Is it seasonal? Is it fundamental? A lot of people think algos react to technical, analysis. That is not the case. That is not how the money flow works. So we're going to be going over a lot of things on, relative value of all the commodities right now. How much of this is inflation? How much of this is tightness? What are going to be the new lows? What are going to be the new price relationships between commodities? Because remember, we are now moving into a period of energy policy where renewable biofuels is going to be a big deal. We could have soybean oil. What soybean oil could do to not just the soybean complex, but the major grain and oilseed markets overall, be very similar to what ethanol did for corn, back in 2007, and that just radical change we had in acres and demand from 2007 to 2012. So we're going to be going all over these things. Keep in touch with Turner Stake. Follow us on Twitter. Sign up for the newsletter, and we're going to be, and it's going to be good. And I'll send links out to that YouTube channel because we're going to start clipping a lot of these, a lot of the finer points, a lot of the points that I really like that I want people to understand are going to be put into that YouTube channel and also onto Twitter. So thanks everyone for attending. If you have any questions for me, if you want to work with me, if you're already a client or, we've been talking about futures and options, get in touch with us. We are very excited about this series and what we're going to be doing here over the future. So thanks very much. And you can, all my contact information is here, but feel free to reach out anytime. All right. Thanks everybody for coming.